Hey everyone, in this video, I'm going to highlight two top ETFs I will be buying in 2024 and beyond for that matter. I've been buying these ETFs for several years and I'll likely continue buying these ETFs for several years more. In this video, I'm going to do more than just give you what these ETFs are. I'm going to share with you why I like these ETFs specifically, meaning why these ETFs, and I'm also going to share with you why I choose these styles of ETFs, the two styles of ETFs I'm choosing here. Finally, I'll also share with you my top tip for how to invest in an ETF, the strategy that I think works best in the long run. So stick around, stay tuned, let's get right into this really interesting video.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the two ETFs, the two top ETFs I will be buying and have been buying are VBK, which is the Vanguard Small Cap Growth ETF, and VBR, the Vanguard Small Cap Value ETF. But before I get into why I'm choosing these two specific Vanguard funds, I want to talk a little more about the style. Why small cap value and why small cap growth? So let's go into detail on that. So here I have an interesting chart here for investors. Now on this right hand side, what there is listed is all the different asset, well, not all asset classes, but several different asset classes in ranking of risk. So you have cash, which is essentially the safest thing, right? There is no investment risk with cash. You will lose guaranteed with cash. How will you lose with cash? Well, every year inflation will decrease your purchasing power. So cash is a guaranteed loser. The next thing is the 10-year government T-bond. That's the next least riskiest asset. Then you have investment grade corporate bonds. These are bonds from corporations rated as high credit or high credit scores. The next one is junk bond. These are bonds from corporations with bad credit. These could be riskier because they have too much debt. They're in financial trouble. They could be going out of business. These are called junk bonds, bonds from companies that are in danger of not paying back those bonds. Then you have US large stocks, large cap stocks. Then you have developing market stocks. Then you go into US value stocks, US mid cap stocks, and US small cap stocks. And finally, the riskiest of all is emerging market stocks. And so what I've selected, you noticed earlier I shared with you small cap value and small cap growth. So I'm on the almost the most riskiest spectrum here in terms of riskiness of the style I've chosen. I've chosen one of the riskier styles for investment. Now, my subscribers might be a little surprised to see this because all year and all 2 years long, I've been talking about not taking, or this stock or that specific stock is too risky, or this stock is too expensive. And they've come to the conclusion that maybe I'm a little bit risk averse and I don't like to take risks. And what I've said time and again in the comment section when I see those comments is I'm not risk averse, right? I'm not. What I am is I like to make sure I get compensated for taking risk. I won't take a risk that I don't feel like I'm getting paid to take. Why take a risk if it's not going to pay off? That's my thinking. And so with US small cap stocks, you're taking risk, but you're getting compensated for that risk theoretically. So this chart is a plot. On the bottom hand, you have standard deviation, which is measured in volatility. And the riskier, the more you move along this right-hand side, the riskier your investments are getting, okay? And then on the left-hand side, you have the theoretical annual return, compounded annual growth rate. This is what that investment is theoretically supposed to give you if you were to buy and hold it. And the time period is between 2003 and 2020. Okay, so you can see here the US small cap stocks are right here. They're all the way along here in the riskiness, but they're all the way up here in terms of annual return. So you're taking one of the highest risk, but you're also getting compensated for that. Look at the annual return. It's among the highest of any of the other investment, save for this one investment up here, which looks like emerging market stocks, which have performed better than they were theoretically supposed to, or they were theoretically supposed to perform better because you're taking a lot more risk, but in actuality, this is where they perform. You can see here the chart says this is the actual relationship, this is the theoretical relationship. So the squares are what actually was returned in this period, and the circles are what was supposed to be returned in that period. So for small caps, this is what was the theoretical relationship. This is what you actually got in this time period. So you didn't even get what you were supposed to get, but still it was among the leaders in terms of overall return. In fact, it is the leader in terms of overall return of all of these different asset classes. So you're getting compensated for that risk. You're not taking the most risk, right? Emerging market stocks were the riskiest. You're not taking the most, you're taking less risk than emerging market stocks. You're a little bit to the left of that, but you got better return. So that's what I look for. It's the risk versus return, the return per unit of risk. That's what I'm trying to optimize in my investing strategy. I'm trying to take the risks that give me the biggest payoffs. And I don't want to take any risks that don't give me any payoffs. That's the strategy. And that's what I teach in my university classes as well. It's not that investors want to avoid risk. It's that prudent investors want to get rewarded for the risk that they're taking. Now, if I was an older individual and I was a few years away from retirement, then I would be definitely interested in decreasing risks because I'm approaching retirement. I don't want 1, 2, or 3 bad years to change my retirement plans. And so I will go to the left of this risk spectrum. I'll add more T-bonds, I'll add more investment grade credit, I'll add more large stocks, and I'll move down the risk spectrum as I get older. So that's why I've chosen this particular style, the small cap value and small cap growth, is because those are the ones that give me the best risk versus return. And that's why I've chosen them. Okay, so I hope that clears up the style choice. Now let's get into why the VBR and VBK, because you can get several different ETFs that will give you small cap growth and small cap value returns. But I've chosen the VBR primarily because of the low expense ratio, 0.07%. It's one of the lowest expense ratios. In fact, all of Vanguard's family of ETFs are typically the lowest cost structure expense ratio. And that's good for me because I don't want my returns going to pay for expense for the ETF. I'd like to pay the smallest fee possible. I also like that the fund is split between several stocks. Let me show you what I mean. So here is the holding details. So this ETF is spread across 832 stocks, with the highest weighting being the percentage of the fund being Builder's First Source with 0.63%. So a small share from this stock. So you're not getting these big shares, right? I've shared with you another video where there are some ETFs, like a large cap ETF, where you have like the top 4 stocks are like 10% of the fund. That's too much weighting on few stocks for me, and that defeats the purpose for me of investing in a fund, in an ETF, because I'm investing in an ETF to spread my diversifiable risk, which is to spread the risk among companies and not have too much risk, too much invested in one company. Okay, and the same goes for, that was VBR. This is VBK. The same reasons for VBR, I chose VBK. Again, a 0.07% expense ratios. It was the lowest among the funds that I researched when I was looking to find a fund to invest in. And also similarly, the spread between several different stocks is similar. No one growth stock that has too much weighting. And here is that information here. So it's spread, the percentage of fund here, 0.99% is the highest weighting stock, higher than the other one because it's only spread across 640 stocks instead of 800 and something, but still 1% as the highest percentage weighting. I'm okay with that. I prefer this. And so this is why these are the two ETFs that I have bought and I will continue buying. Now, to answer the question, what's the strategy? What's my tip on the strategy to invest in these ETFs? The strategy is to take whatever amount that you plan to invest and spread it across 12. So let's say this year in 2024, you want to invest $12,000. Okay, so spread that out in 12 months, $1,000 increments, and purchase on the same day of every month of the rest of the year. Set it on automatic if you can. If your broker allows you to set it on automatic, set it on automatic. $1,000 purchase of VBR, $1,000 purchase of VBK every month for the rest of the year. And if you're planning on doing beyond that, go beyond that. So decide your plan for the year, what your monthly increment is, and add that every month. Take emotion out of it. Take your biases out of it. Because if you don't, you might fall in the trap of thinking, oh, the market's up so much this month. Let me not contribute yet. Let me wait for a pullback. Or the market is falling. I'm scared to put it in this month. Let me wait next month, right? So by making it automatic, by telling yourself you're going to do it every month, you take away that bias. And over the long run, they'll balance out. 1 month, you might buy it a little bit higher. The next month, you buy it a little bit lower. And over time, it'll balance out. And in the long run, if you do this with a disciplined approach for 20, 30, 40, 50 years, you're very likely to become significantly wealthier in that time. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.